Good evening, ladies and gentlemen. My name is Steve Goodey, and welcome to this evening's webinar, Wellington Property Profits. I am online this evening for about an hour, and I got some interesting stuff to throw at you about the Wellington property market, and also about funding and finance in general around the country. First thing I'll do, though, which is always useful, is introduce myself. That's me on the left, and let you know that what you're looking at is GoToWebinar Control Panel, which is a piece of software that lets you see the presentation on my laptop, and it also lets you ask me questions, which can be really fun. And it means that we can answer your questions and do a decent sort of Q&A session during the webinar live as it happens. We might be able to answer the question that you may have. So if you wanted to go into the webinar software control panel there and find the questions section, and just so that I can see that you're actually online and that you're live and that I'm coming through nice and loud and clear, just chuck in the town that you're actually coming into from today. That'd be great. So let us know if you're from Wellington or from Auckland or from Christchurch or offshore or international. Excellent, that's coming through. Christchurch, Wellington, Geraldine, Sunny, Petone, Cambridge, Christchurch, Wellington, Auckland, Wellington, Tauranga, Wellington, Wellywood, Sydney. I wonder if we can get anybody further afield than Sydney tonight. I have had people from all over the place. Wellington, Tauranga, what a Bostic. Wow. Thanks, Phil. Yes, that's true. Lower Hutt, Palmerston North, Wellington, Wainui, Palmerston, Wellington, Perth. The mighty Perth. Sorry about your rugby team. Excellent. Hey, great to have you guys all on board with us tonight, and thanks for joining us. Now that you know how that questions section does work, feel free to jump on there anytime you like and ask any question that you like, and we will attempt to answer it as we go along. We'll also do a decent Q&A session at the very end of the webinar as well. If you've got any other questions, bang them in there, because my guest and I tonight have some interesting ideas and thoughts to throw your way, and you may not agree with all, or let's face it, any of them. So hey, let us know, and let's make this a discussion back and forward, because it makes it more fun for me as well. Awesome. So as previously mentioned, that's me. I'm your host this evening. I'm CEO of PropertyTutors. I've been a property investor for 20 odd years, and absolutely love it. Love sharing my knowledge and coaching other property investors these days as well. And so therefore PropertyTutors was put together. PropertyTutors has been running coming up on 8-9 years now. We are based both in Auckland and Wellington. This is the Auckland photo, obviously. Boom, bada boom. That's our little office there in Auckland, where the red arrow sits. And myself, I'm personally based in Wellington. I've lived in Wellington pretty much all my life. Understand and love the property market in Wellington very, very much, and really get a kick out of it. Really enjoy showing people around the Wellington property market and getting my head around where it sort of sits. Traditionally, as you probably would know, the Wellington property market tends to follow what's going on in the Auckland property market around about a year or 2 years behind the Auckland property market. And interestingly enough, that's pretty much exactly what's happening right now in Wellington. Just a smattering of property articles that we've seen come through the press lately. There's been an awful lot of talk recently about this sort of boom going on in Wellington, and I'd like to say that, hey, yeah, Wellington is sort of booming. I'd love to be able to say that it's absolutely booming and going through the roof, and if you look at the stats and you look at the numbers, you'd be hard pushed to say that it's not absolutely going through the roof. But as a property coach that goes around and does 2,500 open homes every year, I get a real feel for how much property stock is actually sitting on the market and stagnating, and how much property stock is moving along and happening and ticking over and that type of thing. And so I've got a few thoughts and a few sort of comments on that as well, which I'll share with you as we get into some of the stats here, really. But hey, while I'm here, I might introduce our guest speaker this evening as well, just because, I get lonely. Hey, and he's a lovely guy. Hey, Dave, how you doing?
Great intro, Steve. Good evening. How are you?
Good. Thank you very much. Hey, cheers for joining us. Mr. David Windler, founding person, owner of mortgage supply company, based out of Auckland. How else would you describe yourself? Lanky, cricketer, all-round decent bloke?
Yeah, I'd hope that. Looking forward to tonight's webinar because I think, as you've mentioned already, we're going to try and sort of free-flow things a little bit more than we usually do, and your questions are really, really important because what we want to try and do is take my part of the presentation where you want us to take it. I think there's a lot going on right now, but we're really looking forward to finding out what you want us to talk about. So, do use that panel bar on the right-hand side and start putting together a bank of questions that Steve can use a little later to hopefully pick what I've got left of my brain cells.
Yeah, absolutely. Let's give that a go. I think possibly another interesting sort of concept, I suppose, for our listeners tonight to get their head around too is that Dave, you've been working with Property Tutors for, oh geez, how many years now? 6, 7 years?
Since the start, yep.
Yeah, from inception. Yep. And you've been funding a large amount of the clients' projects by being their broker and finding them funding in the marketplace. And we've had a market that's been absolutely booming, gone flat for a few years and has actually come back to booming again. And now there's interesting things going on in both Auckland and Wellington. But, to be fair, your wife is still in one of our coaching programs and still buying houses and making money and doing stuff. Is that correct?
Yeah, absolutely. I mean, I think that's been a great thing for us personally is that outside of me very much being involved in being a specialist in financing expert property investors is getting into it ourselves, and that's just built up another level of experience for me. And for us as a couple, I'm time stressed, so for her to get into it has just allowed us to do many more things and leapfrogged us forward. So it's been a good year for that, and despite anything you might hear around the Auckland market, there's still good things happening if you get involved and get stuck in and you're motivated and just make some smart decisions along the way.
Yeah, absolutely. But I mean, I suppose the angle I was kind of getting to from that is that you're seeing all of the deals come through that our clients are buying, and you're funding a lot of them for them, and then you've also got skin in the game. So you're coming from a position of having knowledge in the market yourself with what you're buying and selling, and also seeing what everybody else is doing as well. So it's you're doing that, and I'm investing and renovating myself and coaching 100 or so clients on and off, and hey, we're boots and all into this, up to our eyeballs in property ourselves, and moving forward with our own portfolios. So we've sort of got both sides of it nailed. And I'd like our listeners tonight to think that, hey, we actually do know what it is that we're talking about. So what I'll do now is I just want to discuss some really quite raw stats at the moment. 12-month change and average value in the Wellington property market. So on the little chart, you've got your map there, and you've got Kapiti Coast, Porora, Upper Hutt, all the way down through to Wellington East, and then New Zealand as a whole. Now, what you'll see there, some really interesting stats, is that New Zealand as a whole has gone up in the last 12 months by nearly 13%. What may shock you is that every single portion of Wellington has gone up by more than that in that period of time, some of them by twice that. The other interesting part is I've always, I suppose, raved on, pushed hard, been an advocate for my local area of Lower Hutt. So if you go down there to number 5 and have a quick look at Hutt City, what you'll notice is that Hutt City not only has gone up by the largest amount, being 25.6%, meaning it's literally gone up by a quarter in the last 12 months, but it's still one of the single most affordable places to purchase a property, because average price is still under $500,000. I mean, I think that might surprise a lot of people out there. Did you know that, Dave? Did that sort of jump into your radar at all?
Oh, look, I think for me personally that this is just a trend of something that we've talked about for a couple of years, is that the Wellington marketplace, we were talking about it 2 years ago as being something to get into and keep an eye on, and the stats that you're showing here is just potentially proving that to be the case. I remember vividly talking at one of your events a couple of years ago, and we were starting to signal this happening. Wellington to me makes sense. It's capital city. It's got the infrastructure to support, the property environment. It was just lagging behind Auckland. It was a star, waiting to happen, and it looks like it's definitely happening.
Yeah, yeah. Hey, Dave, I've had a couple of comments come through that you're slightly hard to hear, so if you could lean into that microphone and scream at it a bit more, that'd be awesome.
Sure can, no problem at all.
Appreciate. All right, so, I mean, we've got these stats sitting here, and it's saying that wider Wellington region's gone up sort of 21%. Values that, or people look at a tide mark, if you like, of values based on the peak of the previous rise. We're now in Wellington 30% above the previous peak, which was the peak of 2007. Average purchase price in Wellington still below $500,000. Average purchase price in Auckland, do you know what that is, Dave?
God, no. 800, 900? What's it
it's actually
like
over $1 million.
Yeah,
quite hard to believe.
Getting up there.
It's
absolutely. Yeah, and we deal with a lot of clients from a whole variety of situations, investors, first home buyers, and you start looking at the numbers, and you're really having to work hard to spin the numbers well enough for it to work for people now.
Yeah, yeah. And I mean, what I suppose I'm getting at is, I think Auckland has always been a fantastic place to hold a portfolio, to have a couple of properties in that market. It's a great place to own housing. It's had massive booms in the last few years, and it won't stop because of population. But having said that, we're now sitting here in a place where we've got a Wellington market which is booming and has exactly half the purchase price of the Auckland market, which makes it a really cheap entry point to get into. And I know you want to cover some issues on that, later on as well. So, I'm looking at these numbers and going, in reality, the Porirua market has some really high value properties and some really low value properties. Upper Hutt tends to be slightly lower value or purchase price or entry level than the Lower Hutt market. Wellington Central, around $700,000-800,000 per property on average is really healthy and has gone up 17, 18, 19, 20%. But Hutt City and Hutt Central up 25% and still under $500,000 average purchase price. And I know for a fact, because we did it today, there's plenty of houses out there that you can buy 3-bedroom standalone houses for under $350,000. And these are the sort of houses that are getting $450 a week in rent. So they work cash flow wise as well. So you look at these fundamentals that are available in the marketplace, and this stuff works. It works really nicely. So that's kind of where I'm at now. What I said previously is that Wellington is sort of booming. What I'd also like to add into that is a little bit of negative, well, not negative, but reality, if you like, because I'm not all kittens and sunshine. When I keep a bit of a graph of how many properties are listed on Trade Me for sale in the Lower Hutt market. It's the least scientific graph you've ever seen in your life, because sometimes a developer will come on with 25 properties that are just empty sections and he hasn't built the houses yet. It's rough. But we actually had a rock bottom about a year ago of 180 houses on the market in Lower Hutt. It was the lowest it's ever been on record, ever. It comes up to a nice, healthy 400-500 houses in the middle of summer when houses are selling slowly. At the moment, we're sitting on 341 houses on Trade Me, as I talk to you tonight, with an average sale time of only 22 days. Now, that's pretty phenomenal because the 22 days includes a home buyer sitting down with a real estate agent, signing a form to say that they're going to sell their property, and then that agent goes and takes photos and tries to get it in the local paper or gets it online, and that's when the days start. And so 22 days is actually lightning fast. So to have the average be 22 days is pretty amazing. It means that property stock in the Hutt Valley and Wellington as a whole is ticking over and moving over very quickly. There's stuff happening, which is, fantastic. So next, what I'd like to basically cover is what is actually the trick, I suppose, or the intention, or how do you create wealth for yourself and your family through real estate and through property. And then I'll circle back to where and how and why and hit some more of your questions as well. So first thing is how property makes you wealthy. Firstly, I think that most people online tonight either have or will have very shortly or desperately want a home of their own, something that they've got their name on. Now, I consider this to be the castle, basically. This is home base. This is where you live. You do it up, you renovate it, you love it, and it's become more important in recent months with changes to loan-to-value ratios. Everybody would have heard the words loan-to-value ratio restriction, and what it basically means is that previously you could borrow quite often up to 90% of the purchase price on a property. You with me there, Dave?
Yeah, absolutely. I know where you're going.
And they put the brakes on. So the Reserve Bank came in and said, hey, we want to be a bit more sensible, and so they've put some handcuffs on local banks in New Zealand and basically said, hey, lending 90% of the purchase price of a property is a bit ridiculous. So they said, why don't you bring it down to, I don't know, 70, 80%? They did that in Auckland for a while. It cooled the market slightly, then the market took off again. And so they brought it right down to 60%, meaning that right now, if you're going to buy an investment property to own it long term or to trade it quickly for a profit, you need to go to a bank. The bank will look at you and go, yep, no problem, we'll give you 60% of that. Where's the 40% going to come from? So for most people, the 40% is going to come from their castle. It's going to come from their home, their house, the place that they protect the most, the equity that they protect the most, the thing they least want to lose, and hence why I explain it as that castle. So what happens is you buy a home, you go out and you get a loan on this home. Because it's your own home and you live in it and you've only got one of them, the banks will still allow you to go to at least 80% on that. Is that correct, Dave?
Yep, bang on the money, absolutely. And this is where, you know, what you've got in terms of your home and what you do to it and the value of it is now critically important because you can leverage so much better against your castle than you can against any rental property that you might own.
Yeah, absolutely. So essentially you go out there, you find a house you like, you move into it, or you've got a house, you get stuck into that. The bank's going to come along at purchase and say, hey, look, we'll lend you 80% of this, because they know that you're going to pay that property off first. They know you're going to make sure that you own that property for a long period of time. I think from memory, don't commit me on this, I'm fuzzy on the stats, but average home ownership length in New Zealand sits around about 8 years. So if you buy a house and own it and live in it, you're likely to be there for at least 8 years. So bank's going to give you 80% of the money. You only have to come up with 20% deposit at purchase, at point of purchase. So 80% from the bank, 20% deposit at purchase. Anything above that in equity as it happens, meaning as the property appreciates or as you pay it down, is increased equity from annual capital growth. Now, I say that like it's guaranteed and it's going to happen every single time, every year to every property, and it doesn't. Wellington's just gone through a period of maybe 5 or 6 years of very, very flat, no capital growth. So Wellington's boom of 25, 30% in the last few months has been a welcome relief to those of us who have a portfolio in Wellington. Auckland's already had that. They've had a massive boom. I'm looking at it going, well geez, I mean, surely anybody who's bought just about any doghouse, horrible, nasty property that needed loads and loads of work anywhere in the Auckland region in the last 5 years has to have built in about 40, 50, maybe 70% equity in that property by now. In Wellington, that's just started moving. So that top box, the increased equity in the deal, in the property, that's the only part of the house that you basically really do own yourself. But the good news about that is that that property that you may have been living in for 6, 7, 8, 9 years, whatever, at this stage, that property can be revalued, encompassing the entire growth that's occurred in the last few months. And in Wellington, that might be more considerable than you would imagine. We see every day people undervaluing their houses. We think they really do come up really nicely at the moment. It's well worth going on to any of the free websites. TradeMe's got one, homes.co.nz is another great one, and figuring out what your house is worth based on comparable properties around it, or paying the money and getting a desktop or a registered valuation. You would be very surprised, if you live in Wellington or Auckland probably, what your house is actually worth today right now. The bank will then look at that new valuation and go, we will still lend you 80% of that, which means you've created some equity there, and you've created some value in your castle here that you can pull out to invest and do other things with. And this is exactly what Property Tutors do, and this is what we do very, very well. And so from that castle, we basically look at it and go, okay, we'd like to do a trade deal. We'd like to do a property deal where we buy the house and we make some money on it. So we go out there into the marketplace. We might go to Moera, we might go to Taita, we might go to Nainai. We probably wouldn't go to Wainui. Don't ask me why, I just don't like Wainui. We might go to Stokes Valley or Upper Hutt. We might purchase a property that's cosmetically distressed, a little bit nasty. More often than not, it won't be wrecked. It'll just be very dated. It'll be very not good for current use. And we'd purchase, say we'd purchase that property for $350,000. We then put in a $35,000 deposit. Now that deposit comes across from the castle to the new purchase. So you don't need to find that 35 grand, it's equity that you've got in that castle. And Dave would be able to sort that out for you. He's going to set you up with a refinance and a redraw facility, and essentially you just be able to cut the check and take the equity from the house you're living in, bring it over to the trade deal. Then you're going to renovate this property because you need it to come up in value as well. You need to take it from being a 1960s or 70s original property. You need to add some new carpet, throw a new kitchen in it, make it really nice, paint all the fences. You know, we're probably not going to go to council and do whole piles of, put another floor on the top and add another bedroom outside and throw in a swimming pool or anything exciting like that. It's probably going to be 90% just cosmetics, paint, carpet, nice stuff. So that 50 grand reno capital probably comes out of that redraw facility as well. We then go to either sell the property or refinance and revalue the property. On average at the moment, it's not too hard to find a property that you can buy for $350,000, spend $50,000 on it, meaning you owe $400 on the property, and have it revalue or sell for $500,000. It's just not incredibly hard to do that. Why is that, do you reckon? People don't have vision. They don't understand that their old, grotty, smelly, nasty property could look flash new, beautiful, and amazing. So we do it for them. We do it every day. We do hundreds of them. We do a lot of these sort of houses. So it values or resells at $500,000. So once it sells for 500, we take our profit out of there and we inject it back into the castle. We put the money back where it came from. We've sold the property, we've made a profit, we've created some equity and some cash, and more importantly for Dave's perspective, because we're going to go to Dave to borrow the money for the next one as well, we've been able to prove some cash flow and that we can do the stuff, and the bank loves that. Is that right?
Well, I think when you're trading and you're making steps forward with profitability, from my perspective, the lending keeps getting easier. So quite often when I'm dealing with investor clients, the first lend is the hardest one because we're delivered a set of numbers that is the client's situation when we first get to meet them. But then what happens, particularly when they're working in collaboration with Property Tutors, is they start taking action and activity which improves the numbers. Either they're picking up a whole property which has got great cash flow, or they're trading the property and they're making some deposit. The numbers get better, which logically means that the next piece of lending that we do is that slightly bit easier. So we keep on doing more things for people who take greater and more profitable and accurate activity.
Yeah. But I mean, additionally on top of that too, with that profit coming back into the castle from each trade that you do, the cool thing that I really like is that castle keeps getting bigger and bigger, meaning it goes up in value every year. It might stall for a while and go up slower than other years and then shoot up like it has in the last few months, but it does increase in value on average, doubling in value every 8 or 9 years. And so on top of that increased value, we're actually paying it off faster than everybody else is as well.
Well, I think with what we try and do is, we try and encourage our clients to create their own numbers. And I don't mean any sort of mythical kind of way. You've already talked a little earlier about making sure you accurately value any properties that you own. A bit like yourself, quite often we find that people undervalue their asset. Typically Kiwi, understated. Oh, I only think it's worth about 500. When then they find out that it's worth about 700 with a bit of investigation. There's equity there that the client didn't think that they had. So it starts to shift the numbers, and that gives us some leverage. Or quite often we're working with clients who just do things that allow us to create further equity. You drop 85,000 off your mortgage, then we're automatically creating that equity that we can then leverage off and do greater things with.
Yeah, so that 85 grand going back into the castle quite possibly would give your investor the ability to borrow another 250, maybe $300,000 on the next deal that they do.
Yeah, and then maybe, instead of trading one property at a time, that you've got the ability to trade 2 at a time, or if you want to trade and hold, that you've got the ability to go from having to do one thing at a time to be able to potentially do more than one activity at the same time, whether it's a trade and a hold or 2 trades. Our job's to make the money, to make the numbers spin around. We make the numbers work for our clients in line with the level of their activity and their risk profile. Some people will go slowly, steadily, and we'll just do our lending in line with that pathway, and others want to, get really stuck in and do many things at the same time. We'll always try and make the numbers work.
Yeah. And as you say, getting stuck in sort of comes down to the next thing that I'm going to talk about too. So once you've got that castle, that pile of cash, that ability to borrow, and you've done a trade, basically the trading cash machine becomes the business, and the castle becomes the bank that lends the business the money it needs to become fluid. So cash comes out of your house, goes into your trading machine, you do a property deal, cash goes back into the castle and pays it back down again. And so in reality, if you're thinking of risk profiles, the only risk you're really taking is the money that's out of the castle at that one particular time. And so we start ticking that over, we start ticking it over big time. That becomes your business. That starts churning cash over. I sat down with a client of mine a couple of days ago who had made about $166,000 in the last 12 months doing those house trades. Hadn't done that many of them, just ticked a few over, was quite happy with that. As additional cash flow, 160 grand a year odd provable income is very healthy. And once you've put that back into your castle or even paid your house off entirely, what you're building up there is a really healthy deposit fund as well. So that profit then comes back out and becomes this little pot of gold. Now, what are you going to do with that little pot of gold once you've got this trading machine ticking over and rolling over and working really well? That pot of gold is going to get a little bit bigger, and it's going to get a little bit bigger, and you're going to get to a point where you've bought, renovated, and sold quite a few houses. You know the market really well, and trust me, I see this happen every week. You're going to trip over a property which is an absolute gold mine. It's cash flow positive. It's got good tenants in it. You can add a bit of value to it, and you sit there and you go, in a few years' time, this house is going to be worth moonbeams. This house is going to shoot up through the roof. I might actually buy this one, hold it, and sit on it long term. And that's where your deposit fund comes into play. You've earned the money, you've got the ability to borrow, you've got the lending in place, you've got a team of people that can renovate houses for you, you're set to go. And so you start taking that pot of gold and you start putting it from there over to your portfolio. You purchase a house for 350 grand, you put $140,000 deposit in it from the proceeds that you've created from the trading income. You do a cosmetic 50-odd grand reno, revalue at $500,000, 80% loan at 400 with a non-bank lender, and you repay the business the 100 grand. So the money that the large proportion of the money you've taken out has come back again. You still own the property. You still have equity in the property. The property is cash flow positive. the property is renovated and isn't going to cause you any maintenance issues for the next few years, and you sit on it and you fall asleep and you go back to trading property on the other side in your other business. So then basically you come out of the pot of gold and into your portfolio, creating you a larger and larger and larger portfolio. Each time you do that, you recycle and you put the money back. The reason you put the money back into the castle or into your own home is because your home is the only mortgage you will have at that point that you can't claim the interest on for tax purposes. So you might as well leverage the portfolio as high as you can and create the largest redraw facility on the other side that you can possibly have, because that's a fantastic tool to be able to go out and make cash offers on houses and get great deals at any point. Is that pretty much how you see it, Dave? Is that how you set most of your clients up?
Yeah, very much. I mean, I think where we look at a client situation, and the first thing we're always looking at is where's our equity, where's our leverage, and trying to get that out in the form of a revolving credit facility, because the great thing about them is once you've got them, you've always got them. You can use it to trade with, you can use it as deposits for holds, and as you go into the marketplace and undertake activity that just improves your numbers, we're then constantly looking to revisit that flex and go, can we make it any bigger? You know, we've worked with some clients for over a decade, and the numbers change a lot over time, and we're constantly looking to maximize our clients' ability to, you know, keep on creating wealth for themselves. That's what we're built to do, and that's what we try and achieve for them, whether it's through trading activity or holding or a combination of them both.
Yeah, fantastic. And I've just been bounding through a couple of these questions, and I might hit a couple while we're at it, while we're at this far through. I've had a couple of questions in there. Do I pay myself an income out of my trading income? Do I pay myself from my property business? Me personally, no, I don't, but you can if you want. It kind of depends on whether it's fits or spurts of money, to be fair. I know a lot of my clients build up that pot of funds and just use it to recycle back through more and more properties. They get to a certain point where they're sitting there going, done pretty well out of that. They might then renovate the family home again, which actually increases the amount they can borrow, or they might go out and do something, you know, fun and frivolous like a car or a holiday. One of the other questions I get here is Transmission Gully, how's it going to impact over the next couple of years? Well, Transmission Gully, for those of you that don't know, is a massive roading network in Wellington. It's going to go from Tawa, which is 10, 12 minutes out of central Wellington, and it's going to go all the way pretty much to Levin, 2 hours out of Wellington. They've already finished a large portion of it with the Sandhills motorway in the Brown Kapiti Coast area, and the major part of Transmission Gully, which is yet to be complete, still has about 5 years to go, believe it or not. It's a massive, massive undertaking. Additional to that, Transmission Gully comes through to Tawa, and then it's going to veer left and come through Horokiwi and drop down into Petone, which is basically going to open the Hutt Valley up so that people living in the Hutt Valley will be able to drive through Korokora, Horokiwi direction, drop straight down into Mark Ave, Granada, Porirua Basin, and have access to the Johnsonville Mall and also the Porirua Mall directly, which has never happened before. And it's going to mean that you don't have to drive right round either into central Wellington or upstate Highway 58 through Judgeford. And this is massive because I personally think that the Kapiti Coast, Paraparaumu, Paikokariki, even as far as Otaki and Levin, has already seen a sort of a mini boom from values increasing, from people expecting Transmission Gully to be fantastic. We've also seen the release of this Korokora motorway across to Porirua impact on the values in Petone. So I was talking earlier about Lower Hutt as a whole going up 25%. Petone as a suburb is going up at 32%, so it's even higher than the Lower Hutt average, which is higher than the rest of Wellington as it is. So those sort of roading networks and infrastructure things are really pushing values hard at the moment. And in reality, we don't really have much in the way of greenfields developments. We still, and I've been saying this for years, we're still not building enough houses. And so scarcity sits there and ticks over, and yeah, I mean, that's going to push values for you know, for years and years to come. What else? Cool. So moving on, Dave, you're going to talk, I think, now a little about interest rates, LVR restrictions, releasing equity. Basically, what we sort of planned was I'll do a bit on property and a bit on why, and I've kind of done that. Dave's going to do a little bit on finance and why it's so important, and why you're pretty much broke unless you can borrow money. Is that about cover it, Dave?
Yeah, pretty much. I mean, I think I've always felt that I was important, Steve, but I think I'm probably even more important in this current environment, where the availability of credit is an issue. We're in a tightening cycle, and arguably it's been second only to the aftermath of the global financial crisis. And I'm not comparing the two; they're not within a country mile of each other, but it is an issue for investors. Credit's not readily available. And what we're finding at the mortgage supply company is that the level of our inquiry has gone through the roof, because I think you'd agree that any time something gets difficult, the best thing you can do is go and get some advice and some help. And people are coming to us for that advice.
Yeah, and I mean,
so
it is actually an important thing. If you don't have the cash, you're making conditional offers and then going to the bank, and you just can't do it that way.
That's right, and I think it's just harder to make the numbers go around. But I think what I like around your marketplace in Wellington is that it's a darn sight easier to make it happen there than it is up here in Auckland. You only need half the numbers, basically, whether it's half of the leverage or you need less income. It's more likely to work if the numbers are smaller. If you're dealing with an entry-level property and the huts are 300, as opposed to an entry-level property here in Auckland at 700, there's a big gap. So, I think that it just makes things work a little bit easier. I mean, we've still got clients who are going hard out in the Auckland market and doing well, but most of the agents up here would suggest that investor inquiries dropped away a little bit. Where you are, there's first-time buyers have come out in force and having the same fight with investors that we had here 2 or 3 years ago.
Yeah, absolutely.
So we'll talk around a few of these issues, and certainly, as I suggested earlier, really encourage some of these questions coming through. I'd really be happy to take things off on any sort of tangent and make sure that we answer the questions that tonight's listeners have.
Yep, cool. Well, I'll keep bounding through the questions. You keep bounding through this. Let me know if you need me to roll slides over and stuff, and we'll hit it. Yeah,
sure, absolutely. So, in terms of just some of the key things here, we'll talk a little bit around rates and where they're at today. LVR restrictions, we know that they're in place and they're enforced, but I think what we've got to understand is that the restrictions and the credit tightening that's taking place is taking place on 2 levels. It's taking place with the banks, and we know that our banks are bound by these LVR rules, but over and above that, they're putting their own tightening in place for a variety of reasons. One of the main ones being that they are short of capital, and that they're putting restrictions in place on the likes of interest-only facilities have become a little harder to get. We must remember that a revolving credit facility is an interest-only facility, so the banks are making it slightly tougher for us to get them, and they are such a critical tool for our investor clients. So there's a bit of a scrap going on there. But outside of the bank environment, certainly the non-bank sector has tightened up almost to the same degree. And in New Zealand, our non-bank sector is fairly small. There's not the same variety of finance companies and non-bank lenders that we had in, let's say, 2008 when they disappeared out of the market. And the reason is because quite a few of these non-bank lenders lend off the back of what we call warehouse funding lines that are provided to them by a bank. So Westpac might, for example, might give one of our non-bank lenders $100 million to lend. Well, our friends at the Reserve Bank tapped, the likes of Westpac on the shoulder and said, well, actually, that's a way of you circumventing the spirit of our LVR rules, and you can't do that anymore. So some of our bigger non-bank lenders are almost on a par with our banks in terms of LVR. So the solutions have got a little bit messy. And I think, I'd like to go back to the point you were making before about the castle and how important it is, because you can go to 80% on it. I had a client in earlier today that we were doing some work for, and we managed to get an increase to a revolving credit facility that wasn't going to be enough to make the next investment purchase. So what we collaborated on is actually that increase to the flex is going to be used to add value to the home. The money's going to be spent on a thorough renovation of the home, because we can go to 80% of that. We've got an understanding of what the increase in value might look like. And at that stage, it's going to be enough to make the next rental purchase happen. So, little things like that become really important. And when you can leverage to 80% on a property as opposed to 60, it's a really important tool and a big part of your portfolio plan. And, in terms of who's lending, who's not about lending, we are finding it a lot easier to deal with the New Zealand banks than as opposed to the Australian banks. When it comes to shortage of capital, the Australian-owned banks are having to send money across to the Tasman to prop up their parent banks. And they also tend to operate on the shirt tails of whatever's going on in Australia. So in the Australian environment, their regulator over there is called APRA, and it's worthwhile, tuning into, some of the media sites as to what's going on in Australia, because it's bound to kind of drift across the Tasman here in some way. And certainly one of the things that APRA is looking at in Australia right now is the amount of lending that a bank can have on an interest-only basis, and looking to ration it. And if you look at APRA, as in most banking things, it's an acronym, and the P stands for prudential, and prudential means that they've got to be sensible. And part of that sensibility is to restrict interest-only facilities, which is obviously at the heart of what investors have. Anytime you buy a buy and hold, we're going to have it interest-only. If we want a flexi facility, we want it interest-only. And we're starting to find the early signs of some of those restrictions coming in here in New Zealand in a variety of ways. And certainly a very strong message I'd like to put out tonight is get it while you can. If you take a look at the lending environment now, and if you assume that it might tighten up a little bit further, then take the action to understand your situation sooner rather than later. And get it while you can, because we don't know how much more tightening will take place. And certainly if you're in a situation where you've got great equity and you've got good income and you're thinking about doing some property, well, now's the perfect time to look at it, because you're in a much stronger position than much of your potential competition in market who's had these lending rules are having a dramatic effect on it, taking them out of market. So if you're still in market with good numbers, then take the action now as well, because you're going to be able to get stuck in more than the competition can, and because your numbers are going to work so well. And we're certainly finding, some of our clients that we're meeting at the moment, high income earners, high equity positions, and they're really wanting to take advantage of that in market. So you can move through to the next slide for me, please, Steve.
I can do that.
Thank you, sir. So, what we do is, outside of just the mortgage transaction, is that, we're really wanting to try and understand what your goals are, and try and make sure that we get an understanding of what your pathway looks like. And for some people, that's, they want to increase their income piece, and that will be the trading side of it. They want to get that machine working for them so that they're increasing their capital. Others are wanting to kind of prepare for retirement and create cash flow from the acquisition of buy and hold rental properties. And quite often the first step of that is to restructure what you've already got. You know, we make sure we tidy up the current situation and try and do all of this from a stronger foundation as we possibly can. You may be working with a lender that you've approached. They've said no. I mean, that's so common for us to get second-hand inquiry. And what I mean by that is they haven't come to us first. They've come to us after they've tried to do it themselves and their banks just said no. And most of the time we just find that they've just been unfortunate to be dealing with the wrong bank at the wrong time. So don't take no for an answer is the second message that I'd take. You know, if you've had negative feedback from any of the banks out there about what you want to do, you know, you've got desire, you've got goals, you've got aspirations to move forward, but your bank says nah. Well, we're pretty good at finding someone who says yes, or we'll put you on the right pathway to that moment in time where the yes just comes a little bit more readily. And then outside of the mortgage side of what we do, we've got a full, you know, fire and general and life and risk insurance side of things, because, you know, in simple terms, we do put people into risk positions. We give them debt, and we have a responsibility to just make sure we cover that side of the financial services. So, you know, if you're wanting to look at your situation and take a look at your numbers and get to understand your capacity to do these things, then, you know, we're well placed to give you that feedback. Cool. What's on the next slide, sir? That one. That's an interesting one, that last one. Can you back for me, Steve? Sorry, mate. I just think that quite often with property is that, you know, it's a really common theme for us that people love property. They're engaged with it. They want to do more of it. And it might seem that we're drawing a long bow here, but it actually is very real. And quite often we start dealing with clients who want to go on a journey of giving up their day job. And they want to get into property full time because it's something that they're passionate about. And certainly that's something that we've achieved over the years. And I'm not saying that you just go and chuck your day job, Eb, and just, you know, launch into doing property. But there is a journey that you can go on here. And particularly once you start getting active with trading property in the early stages, and perhaps you're working at the same time, then, you know, we've had some real success over a long period of time is drawing people out of what they want to desperately stop doing and helping them do more of what they want to do with property, and helping them create something and being able to lend to them while they're not in a job. And that's certainly something that we work with our clients on too. Thanks, Steve.
No worries. So interest rates, where are we at? What's going on?
Yeah, it's interesting. I mean, the April 17 rates there are basically the best rates that we have had over the last few days here in the office. So I've got a team of about 7 guys here in my office in Auckland. We've got other offices around the country, including one in Wellington. So it's worthwhile mentioning to our Wellington listeners there that Carl Mann is based in the hut, and you know, he's obviously a really good mortgage broker, but also very familiar with the Wellington market. So they're the better rates that we're getting right now, and it's interesting to sort of look at them comparatively to a couple of months ago, and for the most part they've kind of come back a little bit, and I think that's just a sign that at February, the banks were really hard and fast about how far they would discount rates. But they've just come back a little bit off that peak, and there's some decent rates there still on offer. And I look back at them compared to October 16, and on average, they've shifted in and around 0.5%. Look, the most important thing here is that the rates are still darn good. There's a lot of 4s at the front of those interest rates, and that getting cash flow is still reasonably achievable. Once again, especially in your marketplace, Steve, when you've got a lower price point and a solid rental return, you get some decent bank funding with the right rates on it, and you know, the thing's washing itself and it's cash flow positive. So, you know, we're finding that we're still getting some reasonably attractive rates. The hardest thing is getting the cashback component. So, you know, most of us, you'll be aware that, you know, when you negotiate a deal with the bank, there's quite often a cash incentive there. That in dollar terms is a little bit less than it used to be. And the pricing overall isn't as generous. But they're still good. I think the glass is still very much half full. And what we're finding, most of our clients are still settling for those 2- and 3-year fixed rate most of the time. Once you start getting to 4 and 5 years, it's pretty hard to see the value in that. And for most investors, it really does affect the cash flow from property, and they're having to look at putting in some of their personal income, which is not a good thing to be doing.
Yeah, but that's an Auckland problem. We've got really good returning properties down here. I mean, you know, you're talking about 5.5% as a 5-year rate, which is still 2% clear lower than the average at 7.5%. 25-year average being 7.5%. You know.
Yeah, look, absolutely, and I think the thing is with you know, choosing rate, and when you're an investor, is I kind of look at the lending relative to the income from that property and go, okay, what's the longest rate? What's the longest term that this property could tolerate, and still be no worse than cash flow neutral? Yeah. So
yeah, sure.
You know, if you've got something down there in Wellington that's yielding its pants off, and you feel that you have a preference, then you'd go for that 5.44. If that property is part of a number of properties in a portfolio, I think the most important thing is within a portfolio that you have a blend of rates. So you might have one property on a 2-year rate, one on a 3, one on a 5, one on a 1, so that you protect yourself within the portfolio by breaking down those loans into chunks. So you never have all of your lending coming off a fixed rate at the same time. Really important.
Yeah, but also, don't you think that if somebody had a $500,000 mortgage and a blended rate from low to mid to maybe, you know, low to mid 4s to early 5% interest rates, so they've got a couple $100,000 at 4.5%, a couple $100,000 at 5%, and $100,000 at say 5.2, if interest rates go back up to 7-8%, the banks are going to make it really, really easy for that person to break that interest rate, aren't they?
Yeah, they are. I mean, I think that you know, generally speaking, if your rate, you know, rates are on the rise, then break costs become less of an issue.
Yeah. We're not liable to much lower, are they? Let's face it.
No, that's right. So I think, you know, you're not going to, if you fix long, then, you know, you're probably unlikely to suffer break costs as you need to sort of sell a property. You know, certainly that's always something to keep an eye on, is if you're buying something and you're thinking, okay, well, you own something already and you think, I might sell this or look to sell this in 2 or 3 years' time, then the safest bet is to fix it for 2 or 3 years, so that you have your interest rate coming up for renewal at the time that you're going to review that buying decision, decide whether you release that asset or not.
Yeah. But I mean, realistically, banks can sit there with a 5% interest rate on $500,000, and they're going to go, hey, if this person breaks its interest rate and rates have gone up to 6.5%, we can re-lend that money and make more interest on it with someone else.
Yeah, and that's one of the calculations there. You know, if you decide to break a rate and on the day that you break it, the rates are higher than the rate that you've got, it's unlikely you're going to have any break costs, because you're quite right, the bank can then lend it to someone else at that higher rate.
Yeah, interesting, eh? I like that.
Yeah, absolutely. Yeah, I mean, I think, you know, in choice of interest rate and loan structure is always going to be individual to every person's situation. It's something that's well worth taking some advice on.
Yeah, for sure.
Cool. What have you got next on the next slide, sir?
Let's have a look at why all banks are not equal.
Yeah, I do love this conversation. because they're not. They're really not, and they're at their most unequal when it comes to calculating your ability to borrow based on your income. And it's the number one reason why, you know, for most folk, they might have gone to their bank and the bank said no. It's purely because the income math hasn't worked. But if it doesn't work at one bank, it could well work at another. And the difference between them is exacerbated the bigger the numbers are. So the bigger the income, the bigger the mortgage, the more rentals you have, the bigger the gap starts to grow between how different banks assess your ability to borrow. And the maths can get quite complex, and good experienced advisors are really good at making the maths work to give you the most amount of lending. Because in our experience, if you give a decent property investor more borrowing power, they go and do good things with it. It doesn't sit there being unused. So I don't have too many clients who are, you know, looking to build a portfolio saying they'll take less than I can get them. We spend most of our time getting every last drop of borrowing capacity out of any bank that we can get it from. And it's interesting as I look at that slide that things change. So that slide's 2 weeks old. And you can see at the top there, SBS Bank, which is the old Southland Building Society. We've done a lot of good things with them in the last year or two because of how they treat the numbers. Well, they changed how they assessed their numbers, and I won't go into the detail of how they did it. But if I was to change the ranking on that today, Steve, I'd drop SBS all the way down to sort of 6, 7, 8.
Really?
So, yeah, absolutely. The big advantage of SBS is that if you had lending elsewhere, they would calculate your actual repayments on that lending and not use any different sort of maths on it. And it made a big, big difference to what they could lend. So as a consequence, we were probably the number one provider of third-party business to SBS Bank in the country. That's probably going to change, and it'll be interesting to see in forthcoming months whether they revert back to some middle ground on that, because particularly here in Auckland, they don't have a branch, they don't have a presence, so their unique selling proposition was, this is how we'll treat the numbers. That's gone. I think they'll definitely fall back into the pack. But we're still getting some good results with TSB and SBS Bank. Their calculations are pretty similar. And TSB, SBS were very, very good at giving us those revolving credit facilities too, which is probably why I've ranked Westpac and ANZ a little bit further down the ladder there, because you go to them and ask for a nice big flexi facility against equity that you have, and the common outcome there will be no. Or will be a lot of questions. What do you want it for? Why do you want it? What else are you going to do with it? And it just gets too hard.
Yeah, that's tricky. So what am I doing? I'm sitting at 3, 5, 7, and 8 at the moment. So room for improvement, maybe.
Yeah, yeah. I mean, it's horses for courses too. I mean, quite often when we're starting off with a client who's got really good numbers, you know, good income and a good equity starting position, and wants to go on a journey of adding rental properties to their wealth, we actually quite often will start at ANZ. It makes sense to get the hardest lender out the way first. And as you keep adding rental income and adding mortgages to your overall financial position, you kind of save the best till last. So sometimes we do engage with those Australian banks, even though we don't like them much, first, because it just makes sense in the overall strategy that's where we go.
So I've just got a question from Ross, who says, are these rated as shown? He says, as currently working for ANZ.
Hopefully not anymore. Look, I think the greatest indicator perhaps where some of our banks are at was I was on a drive the other day and I'm listening to the radio, and there was an ANZ advert for fire and general insurance offering $150 should you bring your fire and general insurance policy to the bank.
Yeah.
So I just laugh because, you know, when you're not doing any mortgages or you're not doing enough mortgages, you've got to go and chase some other business, and obviously house and contents policies are a flavour of the month with our new biggest bank in the country.
Yeah.
I shouldn't knock them overly. It's just, you know, we do get some extremely good outcomes from ANZ with their business banking area and commercial, very, very strong there. But with what we do with investors, they just don't suit the style of what we do and the outcomes that we're expected to deliver to our investor clients.
Yeah. So do the likes of SBS and Co-op and stuff, do they have issues with people that have got, say, five plus rental properties?
No, tend not to. Cooperative, maybe to a degree. They tend to be a lender that I would introduce in the slightly early stages where you haven't got too big a portfolio. But certainly TSB, SBS, ASB, no. What tends to happen at some point, and is that all the banks have different segmentation rules. So if once you get to a certain number of properties, you fall out of retail and go into business or commercial. Now, as much as we can, we try and keep our clients in retail because it's easier. There's less of an eye on you. There's less of a review situation, and it's generally easier to get the better pricing too. So we try and spread our clients around a number of providers so that, for the most part, we stay at retail.
So then, how does pricing compare from the top to the bottom of the list? Is ANZ's pricing and interest rate comparable to SBS's?
Great question. You could almost turn it on its head. Almost.
Really?
You could almost turn it on its head. Yeah. We're finding right now, and I say, when I say we're finding right now, I'm saying in the last few days, ANZ and Westpac pricing is pretty damn good. And ASB's okay. TSB's pretty darn good. SBS is slightly off the pace. But if it's a pure pricing exercise, so if we've got a price-conscious client, all we're doing, let's say, is a refinance or a new purchase, we don't need to get a big revolving credit facility. And as long as their income numbers work, we would probably look to ANZ or Westpac purely to get the rate.
Yeah, very cool.
And if you think about it, if we've got a situation where perhaps the couple of the bigger banks are not getting volume through because their policy has tightened up more than the others, then the only way that they can keep those volumes up is to pull the pricing lever and be extremely competitive on price. Yeah.
Yeah, nice. All right, so moving on then. Do you want to work us through this then?
Yeah. Well, I think, when we come to our event 7th of May, I'm sure you'll talk about it later, and I'm looking forward to speaking about, we talk about the property ladder, and we talk about the property staircase and the property escalator, and how we take our investor clients on a property journey of some growth. But I think before we start thinking about what the property staircase might look like, I think there's a personal one to climb as well. And I mean, the best thing is about those of you that are listening tonight is none of you are sitting on the bottom rung there, and the bottom rung being I won't. I mean, there's no point in spending your evening listening to us, go on if you're in that I won't space. It's unlikely that you have that mindset, but you might be thinking that you can't. And I think that's the first thing I want to say is that you don't know until you ask. And certainly when there's a credit tightening going on and it might not seem that it's that easy to get things done, just ask. Just ask for the advice, ask for the help. You'll soon know whether you can or you can't. And I guess that, that will give you the encouragement and motivation to get yourself onto the next step. Well, I'm going to have a crack at this. I will look at my circumstances and see if I can. our job's to try and get you up there to the situation where you're in the market and you're doing, that you're active and you're busy, and hopefully taking you, through a journey right the way to the top. But we can't do that if, we've got a negative mindset. And I think that the best client interactions we have are with people who say, I will, and I can, and I want to, and I want to get somewhere. It's always really motivating for us with the work that we do and the approvals that we get, that our investor clients, our good investor clients, go do something really good with it. I get the privilege of, meeting some incredibly motivated people. I had a young fella drive from Huntley to my office in West Auckland for a 6 o'clock appointment tonight before I hopped on the webinar. First time buyer, came along to the Auckland event, Steve, where you present, was motivated by the content of that day, and he wants to take, some of the property tutor philosophies around, buying well and adding value, take that into his first home.
Yeah, nice.
What was really exciting about this guy was he had some KiwiSaver, but he'd saved a really good deposit. Tradie job, he's a Sparky. And, you ask these questions, do you have any debt? No. Do you have a car loan? No. Do you have any credit cards? No, but I've got one of those debit card things. And he lives with mum and dad, pays a bit of board, saves half of his wages every week. You could just tell, and he's wanted to do this for years, and was really excited to come to an appointment tonight, thinking that he was in the ballpark of being able to get on that first step. But obviously, made some sacrifices. We talked about, making sure that we buy at a pitch point that leaves some deposit left over for renovation. And he goes about saying, well, if I need to, I'll just sell the car. So, sacrifices and motivation and all these sort of good things. I mean, we do get the privilege of, meeting some incredibly motivated people. That was just a great example today. And yeah, man, that was awesome. Really, really cool. Yeah, so hopefully what we do is get people to the top of the ladder there and get some success happening, and whatever that means for you, because it means different things for different people. One of the things I love doing is understanding what a client's goals are, and start working out what can I do to help them achieve that.
Yeah, absolutely. And I mean, that's exactly what we do, and that's what you do and what I do and Property Tutors do, and that's why we put these events on and stuff. And I mean, I love educating, I love telling people why they should need to do some stuff, and this is why I sort of spent a bit of time having a good think about this, the 5 must-dos to profit from property. And the first one there is make equity. And you make equity by buying quality. You buy stuff that other people are going to want after you're finished with it. So you always see these houses that are on fantastic locations or good outlooks and stuff, but even in cheaper, more interesting suburbs, so to speak, standalone houses, 3-bedroom places you could see somebody bringing a family up, buy stuff that will go up in value. The next one would be create cash flow. Make everything you hold pay you money. So if you're going to hold a property long-term, 10 years or so, make sure that it pays you money every week. And by that, I mean, don't do negative cash flow. Don't do something because it's going to create a tax debt that's going to give you an advantage. Buy stuff that's going to make money every week. Third one there, don't buy other people's problems. See this all the time with crooked houses or houses that are leaky homes, and people underestimate the cost it's going to take to improve it and get it fixed. What you do on the other hand is you buy stuff that's ugly or you buy stuff that's dated that you can fix, so you create solutions within that. And, Dave, you do this, and I know that your wife does it with the houses that she does and renovates. You want to buy stuff that's got stuff wrong with it so you can buy it cheap.
Yeah, absolutely. And it's also, there's a fine line there, because you don't want stuff that's got too much wrong with it. It's got to be the stuff, the easy stuff, the cost-effective stuff, the things that add value and touch, let's say, a potential buyer emotionally, particularly in your market, Steve, where I guess probably it's that golden time where you're trading to first home buyers.
Yeah, absolutely. and that's just what you've got to do. So the next step there is to consider property a very liquid asset. A lot of people look at it and go, oh, I've owned this property for 10 years, it just sits there, it ticks over, whatever. It's a really liquid asset. You can trade it, you can buy it, you can sell it, you can get something under offer and find somebody else who wants to buy it off you for more money. Properties are turned over every single day. There's transactions that go on every day. Don't get stuck in the mud about it's a house sale. Everybody's got to live somewhere. Everybody needs a house to live in. The next one, and the last one, and the one that's sort of more topical, I suppose, to what we've been talking about tonight is sort your funding first. If you can't make a clean offer, you're just not in the marketplace at the moment. And what I mean by that is if you're rolling around there looking for a really great deal, and if you look hard enough, you'll find it. You'll find a house that you must own that will make you 40, 50, 60, maybe $100,000 very, very quickly. And if you're not finance approved and have the redraw facility and the ability to go, then you can't actually buy that property, because I'm going to run in and do it before you get there, because I'm cash flow approved and I'm ready to go, or one of my clients is. You can't underestimate how long at the moment it takes to get financial accounts and tax returns and pay slips and bank account details and clean credit history sorted out and all of the paperwork in the background and get it to somebody, Dave or one of his guys, and to get them to actually get your finance approved and set up. You might need to have valuations done on your existing properties. It's a hassle, it's an effort. Do it first. Get that underway. Also get companies and trusts and assets set up, and we'll cover that at our event shortly as well. And then this is where Dave comes in, and this is why Dave and his team have become such an important part of my team, because I don't want any of these things to hold me up. Would you add anything to that? What do you think, Dave? What's really important to you?
Oh, look, I think in the current climate as well, I think you buy yourself more time to get all of that stuff done. The banks aren't quick at the moment. They're a bit gnarly. They're a bit sort of push back on things that we're trying to do. So you're wasting your time if you go into market without the funding sorted. You're just plain looking at stuff. You're going to open homes. You're better off putting that time into really understanding the funding that you can get. And then at least when you go out to market and go to open homes, you're looking at the right sort of property at the right price point. You know that if you're looking for a hold or a trade, you'll understand your strategy off the back of the finance that is ready to go.
Yeah, I mean, it is, and I think that all of these must-dos really don't constitute any sort of restraint or any holding any investors back. I just think that there are a general pack of rules that I think are important to making sure that people don't make any big horrific mistakes. And that's what we teach, and that's what we preach and advocate, and that's why we have such a sort of a large collection, I suppose, of fantastic investors working with us. The other thing we do too, and this has become very big at the moment, and we're really happy with it. We have a fantastic buying strategy with Mitre 10. We push a lot of our buying in Wellington towards Mitre 10. We spend, well over $2 million a year at the moment with Mitre 10, and kitchens and flooring and all sorts. And so they give us some nice stuff and some nice cool prizes. And so we're going to do a prize draw right at the very end of this webinar. But what I'd like to say too is we're putting together these Bosch power packs of tools and bits and pieces. We've got about $2,500 worth of them sitting behind where I'm sitting in my office, actually. We've got all of those sitting there ready to go, and we can give those out anytime we like. And we're basically what we're doing is we're giving them away at our live events in Wellington on the 7th of May, and we're also doing them on the Facebook fan page. So if you want to go to the Facebook page and become a fan of the Property Tutors page, we're going to be giving away more and more of these tool packs there as well. And so, so this is us again. This is me on the left-hand side. You've got Dave Windler there in the vest, and on the far right-hand side, you've got Mr. Don Ha, who's one of the famous Auckland property investing agents and property developing celebrities in New Zealand. He's an amazing guy with a really outlandish story. And I've actually asked Mr. Windler and Don Ha as well to actually come down and speak at the Wellington Property Masters event. That's going to be on Sunday the 7th of May. It's coming up very quickly. Normally about this time, we've usually got about 60 or 70 tickets sold for that event. This year, for some reason, Wellington property market's booming. It's going through the roof. People are really interested in this, and we've got over 135 tickets sold already for that event. And so, once again, we're going to have a sell-out event. I would imagine we're going to have to put the sold-out sign up before the event. People are going to miss out on that. So, that's going to be a pretty decent-sized event. To give you an idea, our Auckland event, which was a couple of weeks ago in the Langham Hotel, we normally get 320 to 350 odd people come to that event. This year we had 488 people turn up. We had to put extra tables in. Absolutely had to pump it hard to get everybody to actually sit down in the room and get a chair. And so, we're running through the tickets very, very quickly. This is a quick picture of me standing on stage in the Auckland event. We put on a real nice event. We do a lot of freebies. We do a lot of giveaways. There's a huge amount of content that we add. What we've done this year that we haven't done in previous years is added a whole pile of new content to cover the new marketplace that we're in. And hence why we've called it the Masters 2.0 event. We've actually rewritten virtually everything in the event. We've also created a situation where we're doing a lot more classroom style teaching. And so I've got a massive whiteboard in the middle of the stage there, and I actually teach a whole pile of stuff as well live from the stage, which I think you'll find incredibly interesting. We've really ripped this event to pieces and put it back together really nicely. So, this Auckland event had, as I said, 488 people turned up to the event in the morning. We managed to get 450 of them basically in the room for the full day. It was a huge, huge event, massively oversubscribed. And a lot of that's just packed. Sorry,
yes,
Dave?
Sorry, Steve. I spoke at the Auckland event, and I've got to say, I think it's the best event we've run. I think that the content had a bit more depth, was rounded. I mean, we've done some really good stuff over the years, but I thought 2.0 was a really good event. Thoroughly enjoyed it myself, thoroughly enjoyed listening to the other speakers, and if we replicate anywhere near that standard in Wellington, it will be a good day out.
Yeah, no, it was really excellent. We got masses of feedback this time saying that it was so much better than we've done in previous events, and we're stoked with that. We really were. And the feedback keeps coming again and again. So I've just put a table of 10 aside for some ex-clients of mine who want to come along and listen to the content because it's all new stuff, and because Don Ha, who's a really interesting guy, hilarious story, great content. He's never spoken in Wellington before publicly and told his entire story. I think it's going to be a massive, massive event, so I'm really looking forward to it. So we're going to throw an offer at you tonight so you guys can grab a ticket to the event. It's basically a $47 ticket. We're going to let this offer roll open for 60 minutes if you want to grab a ticket. We've actually upgraded it to reserved seating allocation, which means you get to sit right up the front, nice tables and chairs seating. It's $47. Now the $47 is for a double ticket, so you can bring somebody else along with you as well. And basically you can pick that up on our website, which is bookthedeal.co.nz. And if you bang across to there, we're going to leave that offer open for 60 minutes tonight so that you can grab yourself one of the last few tickets to that event. It could sell out tonight. We've only really got very limited tickets. So, if you want to grab your ticket, grab it really quick. So that's bookthedeal.co.nz. It's $47 to grab your double ticket, so two people can come along. So you can bring a spouse, a business partner, you can bring whoever else you need to bring along. And myself and Dave Windler, my co-speaker tonight, will be there. We'll be delivering content and answering questions. Hey, Dave, where can people get in touch with you if they want to ask more questions about your broking services and getting in touch with you as well?
Yeah, sure, Steve. I think, if folk wanted to take a look at their situation and have me, and I'll certainly do as much of this inquiry and handle it personally myself, best thing to do is either email me at david@mortgagesupply.co.nz or just hop onto the internet, the Mortgage Supply Company, go to the Contact Us page and pop in a brief message there. That'll actually come through to me. So mortgagesupply.co.nz, just go onto the Contact Us tab, send me a wee message, and I'll look to come back to you as soon as I can. Very happy to take any inquiries from people listening tonight.
Yeah, that's magic. And also, additionally, if anybody wants to get Dave or one of his associates to get in touch with them about mortgage broking, You can always chuck into the questions and comments section there just with a phone number and email address, and we'll make sure it gets through to Dave tonight and it gets on to you tomorrow morning. So as we said, tonight's offer is over on the website. Also what I put on the website is some negotiation tips. There's another quick video over there with some negotiation tips. So if you want to rip over there and jump on there, do so. We're going to do this prize draw for the first though. Let's go. I've got a list of people who are in the prize draw tonight who went over to our Facebook page and answered the question on there. There's 280 entries. It's a Bosch 3-piece 18-volt toolkit valued at about $350, plus a couple of double entry tickets to our event. And let's pull it out of the hat here. Let's go Jess Cummins. Cummins? C-U-M-M-I-N-S. Jess, who may or may not be online tonight, has just won that Power Tools set, and we'll do another draw next week probably. So jump on our Facebook fan page and get stuck into that as well. Awesome. So our event is on the 7th of May, 2007. It's in the Clifton Continental Hotel. Registration starts at 8:30 in the morning. The event starts at 9, goes through to 5:30. We'll do a quick lunch break in the middle. We're going to pack it with content. We're going to teach you as close to everything we know within that time period as we possibly can about property investment. We're going to make it a massive, massive day. It's only $47. We'll do a money-back guarantee or two as well. We'll chuck it in there. We'll say, like, my personal guarantee, if you don't get great value out of this event and learn a pile of stuff, hopefully as you have tonight, then we'll give you your $47 back, no questions asked. The second guarantee that we'll chuck at you tonight is that we won't sell you anything on the day. Obviously, we run a coaching program, but we want attendees to come along and learn on the Master's Day and actually get a kick out of it and take some stuff away and think about it. So you will be able to apply to join the program. We'll interview people later on, but we don't want you to bring money along, a credit card, check. Do people have checkbooks anymore? We don't want you to feel any pressure for sale on the day. We just don't do that. So come along, listen to our content, go from there. So as I said earlier, it's $47, 2 double tickets, and the website is bookthedeal.co.nz. Now, normally about now, and I'm starting to see the texts and emails coming through. I can see people booking already. Normally about now, that website gets jam-packed full of people and it starts kicking people out. If you have a problem grabbing your ticket tonight, put into the questions section of the webinar software here that you've had an issue, your phone number and your email address, and we'll get in touch with you tomorrow and make sure you get your ticket sorted out as well. What else do you think, Dave? What else do people need to know about our Masters event?
No, I think for me, with what we've talked about, tonight we've been a little general, and we've talked and touched on a couple of points that we'll go into a much more depth on in the seminar. For me, my presentation is looking at some real pathways, some real solutions, playing a little bit with the numbers, and the way I try and do it is to try and talk to everyone in the room. So, everyone's going to have a different set of circumstances, but hopefully at the event, what I'll show you is what you can do given any situation, given any starting point. What's the sort of lending that we can get for you, and what sort of activity will it lead you towards? So that's the journey that will go on during my presentation. I'm really looking forward to delivering it in Wellington State.
Yeah, great. And I'll do nuts and bolts. I'm going to tell you about where I started and where I've got to and where I'm heading, how I've done it. I'm going to talk to you about why books who teach you how to do property investment can't get you where you need to go. I'm also going to pull up maybe 10, 15 of my clients on stage and let you guys ask them questions as well. I find that really, really useful because, I can put somebody on stage who had absolutely no money 4 or 5 years ago and has a portfolio of $15, $16 million the way that he stands today. And I think people find that really motivational as well. And it's a clear path. It's a step 1, step 2, step 3 thing. Additionally, you've got Don Ha who's going to stand there and go, hey, when I arrived in New Zealand as a 7-year-old immigrant on a boat, he had absolutely nothing but the clothes he was standing in. And he got to the rich list in New Zealand, which at that point meant that he was worth $60 million, and he lost it all. It went back to zero. And today he's back and he's got a thriving business and he's doing some quite substantial and incredible property deals, and how he got back to there and the lessons he learned. As I said earlier, I mentioned that he had a really stunning story, and that's definitely a large part of it. He's amazing. And we're going to chuck some people on stage who are just exactly like you guys that are listening into the webinar tonight, who maybe started with something or absolutely nothing, or are doing really quite well, but just want to do better and want to learn something, want to get their head around it. Yeah, there you go. So I'm going to answer some quick questions now. If you've got any questions, chuck them into the questions section there and I'll bang through them. Hi, just like to ask if there's another seminar aside from 7th of May. Nope, that's it. We do a couple of major seminars a year, and they're huge. And they're really hard and they're expensive to put on, and we put absolutely everything into them. We get a whole pile of prizes and gifts and giveaways and freebies and stuff, and they're big and nasty. So I'm afraid if you can't make the 7th of May, you are a bit tough out of luck for now. We will see if we're going to do one again later in the year. Other questions about funding and finance we can cover on the stage. Do you need the income to cover your own mortgage and your investment mortgage to make it work? Yeah, you kind of do, but then your own mortgage you're probably covering already. Your investment mortgage is either going to be covered by rent coming in from it, or if it's empty, you're going to be renovating it. You're not actually going to hold it for very long. We typically hold properties for 8-9 weeks when we're trading them. That's from us starting a mortgage and owning the property from scratch right through to us on selling and getting rid of the property again. You just don't need to hold it for very long to rip through it. Okay, what else? More questions. Maria says, just looking at the site now, it says the ticket is for 4 seats. Does it just? Well, we mucked that up. Well, guess what, Maria? Your one's for 4 seats then. Actually, all the tickets tonight can be for 4 seats. Let's get stuck in. We need to fill the room up. We need a couple hundred people. If you guys buy a ticket tonight from bookthedeal.co.nz, it's still $47, but you can bring 3 other people with you. So let's go. If it says it on the website and we didn't update it, then that's what it is. Next question, do seminars get taped for people who can't make it? No, they don't. You're either live and in the room or you're not, unfortunately. It's just kind of too hard. So turn up, come along. Bear in mind, we have people that come to this event who fly down from Auckland, come up from Christchurch, spend the weekend in Wellington, or just spend the day just to hit our event. Yeah, we have a lot of people that take this very seriously, so get stuck in. Hi, how do you view sections, say in a new subdivision? Usually standing from the side of them. I don't think that's really what you meant, was it? Sorry, that was my attempt at making a really bad joke. Sections in a new subdivision, don't mind them, as long as you're building something on it immediately. I don't particularly like holding bare land unless it's likely to go through the roof in price. I certainly don't like holding bare land that doesn't have an income on it of some sort. Reserve Bank restrictions on lending don't include new builds, typically. I had a few questions on that tonight. What it basically means is that if you're building a house or a new build house and then settling on it at the end, you can borrow 80% for that, which is great. But you can only do realistically one at a time at the moment with the way most banks are viewing that lending. Now, there are exceptions and exemptions in both directions to that. And so certainly if you're looking at doing new builds, you need to take some decent advice as well. Got a question here. How much does it cost to join our coaching program? We'll let you know on the day. Simple thing. Ross says, grabbed my ticket, but got to go. Thanks, Steve. No problem. Great to have you there. Thanks very much. Just got a text through from our guys in the background saying we've got 16 tickets sold. So 16 times 4. Jeepers. We are running out of seats. Thomas asks, get my personal life first or make money first? My answer to that would always be, let's make some money first. It's a lot easier to get everything else sorted once you've got the financials sorted. Go to book now, but not sure if my friends who will come. Don't worry, don't just put the names in later on, that's fine. Just grab yourself a ticket and you can choose some people to bring with you at a later time. But hey, if you've got 4 people you can bring along, then that's awesome. We can make that happen. When wanting to trade a property, do you worry about the tax you have to pay when selling within 2 years? Great question from Jane. I don't worry about it as such. I just pay the tax. If you're going to make $40,000 or $50,000 profit, you're going to be taxed on that, and you will pay around 30% tax. I say around 30% because I don't know what your costs and expenses are going to be exactly. You're going to pay income tax and a bit of GST on it. It's going to come to around 30%. The good part of that is if you make $40,000 or $50,000 profit, you can show those financials to Dave Windler and your broker the following year and say, hey, look, I made this profit, I made more money, can I borrow more money as well? And that's always massively useful, so we can do that as well. Marcus says, arriving a bit late for 7th of May, could you keep it light for the first 45 minutes? That would be great. Hey, look, I'll see what I can do just for you, Marcus. I won't worry about the other 300 or 400 people in the room. I'll just waffle on for the first 45 minutes because you're going to be late. I recommend you bring an apple for the teacher when you turn up. Another great question here. Can you claim GST on your renovation costs? Yes, you can. I'm going to show you this in great detail when we get in the room on the 7th of May, but essentially, if you're buying a house with the intention of making a profit when you sell it in a short period of time, you must claim the GST when you purchase it, and then you must pay the GST back when you sell it. But you're also allowed to claim the GST on all of the costs you have along the way. So that's renovation, the kitchen, the carpet, you know, except all of that type of stuff. So absolutely you can claim the GST. Awesome. Geez, more ticket sales pumping through there. Thanks, Phil. See those ones chopping over. Magic. Lots of stuff going on. So there you go. So bookthedeal.co.nz, $47. We've recently discovered that's not for 2, but for 4 tickets. Extra value. And remember also to become friends on our Facebook fan page over at Property Tutors Facebook page for more drill kits and freebies and stuff. Hey, look, well, that's me for tonight, guys. As I said earlier, grab your ticket right now. Chuck it into the questions section if you can't get through the website, and we'll make sure you get your tickets as well. And grab those last few tickets as they sit there. And we look forward to seeing you on the 7th of May. We're going to teach you a whole pile of really cool stuff about how to trade properties for profit and how to build up your equity funds, start buying a whole portfolio as well. Lastly tonight, I'd like to just thank profusely Mr. Dave Windler, who's had a big, long, hard day of clients and property and funding and money, and then jumped on a webinar and didn't know what the heck I was going to ask him by way of questions and things, and handled like a true professional as usual.
Thank you, Steve.
I really appreciate it. Thanks, mate. Really, that's great. And hey, it's 9:05. We've got 25, 26, I think, tickets sold by the look of it now. So I'm going to call it. I'm going to leave the screen up for you guys who want to grab your last few tickets. That's going to run for about another 40 minutes, and then that's it. We'll pull the plug on that deal. Look out on the Facebook fan page for more webinars, updates, free drill kits, and freebies and bits and pieces. And we'll see all of you on the 7th of May. Hey, thanks very much. It's been great. Bye.